We're going to talk about the income statement. We're not going to exactly model yet. We're just going to go about finding the historical information and where exactly do you go in the 10K to find it, and what does each line item on the income statement mean. Okay, so let me first pull up the model. So you guys should have this downloaded off of Dropbox. This is a, see, there's a, let me move this. Crap. There is a empty version, and there is a full version, as you can see. And you can use a full version to somewhat kind of refer back to, but in the beginning, your net income is not going to match because we have on this one we normalize the income statement, which we will get to in a second. But we're gonna focus on the just laying out the historical information. So this is our income statement. Let me zoom out. This is our income statement, and we have our total rev all the way to over here. Majority of the time, you're just gonna see about this much information on the income statement. These other things we have to derive from other parts of the 10K, but it's not hard to do. And this is kind of like finding our Ebitda, which we'll talk about in a second what exactly Ebitda is, our basic EPS, and we'll basically get into that in a bit. Okay. Alright, so I have my PowerPoint pulled up over here. Okay, so basically we're going to talk about gathering historical documents and resources for our projections and using the shortcut find key, Control F. Now let's just say, and we're going to use this in a bit, but this is our 10K, so let me scoot all the way back. I'm going to go over just small shortcuts with you guys, just to get like a start on how to actually use them and how to get used to them. First one is obviously the find key, so let me exit that out. So when you press Control F on PDF, you have this find box, I guess, on the top right, and you can type in basic and you can find information like that, and anything with the word basic in there you can find, okay, or revenue you can find. Now this comes really in handy when you're looking for non-recurring items and stuff. We're just fishing through 10K, you could just type in the keywords like non-recurring, unusual, one-time charge, stuff like that you can find by just typing into the box. Okay, another shortcut I want to mention to you guys, this is very useful, is Alt Tab. What Alt Tab is, you're gonna have this box that shows up and basically has every single application you have open, so you can just kind of channel through it like this. This is very useful. Trust me, this is very useful when you have 4 or 5 documents open. You have the 10K open, you have the consensus estimates and whatnot. You have all that open. So this really helps you out when it comes to kind of fishing through and kind of zooming through everything. So you have your Alt Tab. Then you have your Control F, which helps you find information. Okay, and then another one I'm going to talk to you guys is Control page down or page up. Now, depending on if you're on a laptop or if you're on a desktop, your page up and your page down buttons could be on the top right corner, or it could be at the bottom, or it could be the top of the keypad. It could be anywhere. So just kind of look through it. Mine is my laptop is above my my number pad, which is on the top right corner. So what this does, when you press page down, it switches tabs in Excel, so you can kind of continuously refer to your numbers and see if they're matching, right? So those are the shortcuts we're gonna probably use the most today. And Control Tab to switch through applications, right? Control F to type in information, Control F, and kind of doing that. And then you have Control page down, which kind of helps you zoom through all the worksheets on Excel. Okay, so now we're going to go into what exactly does each line item mean on the income statement. So first we're going to go into total revenues. Total revenues or net sales is basically just all the money that the company has earned through selling their products or selling their services throughout the year or throughout the quarter, depending on which report you're looking at. Obviously, it's going to be the first line on the income statement typically. And how it works is that they're going to take all the revenue, all the money that they earned, and throughout the income statement, they're going to subtract out all the expenses, taxes, interest expenses, other expenses, and then it'll come to their net income. It flows down really well. I think if you want to really compare it to something, it's kind of like peeling out an orange or an onion. Trying to get to the core of the onion, which could be your net income. So you're kind of subtracting out all of your expenses out of your revenues. So that's basically your total revenues. Cost of goods sold. Okay, cost of goods sold are expenses that are just related with making the product, making it through a production process, and such as using a. Hold on, I have a phone call. Let me just pause this for a second. Sorry, guys. I'll be back in a second. About that, guys. Sorry about that. I had to go pick up a phone call. It was urgent. So yeah, where was I? Yes, cost of goods sold. Like I was saying, these are basically costs incurred from just making the product and selling that product. Now, it could be typically in your cost of goods sold, you have overhead counted into, you have your variable expenses counted into, you have a proportion of your fixed costs counted into, possibly depreciation. Not sure about that particular fixed cost. That particular expense. But I know fixed cost, variable cost, processing cost, anything related with making the product and sending it out and selling it, right? So, and in the service-based type of company, maybe you're not going to have cost of goods sold, but you're going to have operational expense or operating expenses. That's typically the same thing, right? Then you have now you're going to notice that you have reported and pro forma. We're not going to worry about the pro forma yet. What we're going to do, we're going to take out non-recurring items from our expenses, and then we're going to normalize, like let's say, our expenses, and then we're going to put them in the pro forma row. But as for now, we're not going to worry about them now. SG&A and other reported. SG&A, let me just first talk about SG&A. SG&A is your selling, general, and administrative expenses. These are expenses of employing someone. These are your expenses of your small things like your paying your executives and stuff like that. That's your SG&A. And other expenses can be a variety of different things. Maybe some very minute expenses that kind of are recurring, but the thing is they're very small and so diverse. Maybe they're miscellaneous expenses that you just group them up into other, and that's it, right? Now, typically, you're gonna have on the income statement, you're gonna have two variations of SG&A and other. You're gonna have companies that are gonna put SG&A and other expenses, and you're gonna have companies that are gonna separate them both. You're gonna have companies that are gonna say SG&A expense and then other expense or non-operating expense. Actually, non-operating is over here. Then you're gonna have other income or expenses, right? So you're gonna have companies that separate those two expenses, or you're gonna have companies that are gonna put them all together. Depends how does the company does their things. Now, for the sake of simplicity, we're gonna put the SG&A and other together. Even in the model, you typically see SG&A and other lumped up together, but you can obviously separate them if you want. But they are both of them are practically treated the same way. And pro forma, like I said, are we're gonna use it. We're gonna normalize the expense and we're gonna rewrite it over here. Then we have our operating profit, also called EBIT. Now, what EBIT stands for is earnings before interest and tax. Okay, make sure you remember that when you walk into an interview, EBIT and your Ebitda, because those are one of the most commonly asked questions in your finance interview. I'm sure it is. So basically, how you calculate is that you subtract your total revenues from your cost of goods sold and from your SG&A and other. Okay, and what you're going to have left is your operating profit. basically the profit that you earned from your operations. Okay, operating profit. Pretty easy to understand. Now, let's just say you tell me, okay, what if we didn't counter in SG&A and other? We just subtracted out cost of goods sold. So then what do we have? Then we have something that's called gross profit. In some models, you're going to see gross profit probably broken down over here, or even in some 10Ks, you're going to have gross profit. And for simplicity's sake, we just don't have it in here. But yeah, you can typically use gross profit as well in your model if you want. And gross profit is also shown in the 10K and 10Qs as well. So gross profit, you do take your total revenues or your net sales, subtracted out your COGS or your cost of goods sold. Now, in order to get your operating profit, you take your total revenues or net sales, you subtract out your COGS, and then you subtract out your SG&A and other, and then you have your operating profit, which is also called your EBIT. Okay, we're gonna mess around with the EBIT in a little while, and yeah. Okay, so now we got to EBIT. Then we're gonna subtract out our interest expense. Obviously, interest expense is basically the interest that you paid on your loans, on the payables that you pulled out for the year for your current notes that you pulled out for liabilities. So any expenses accrued from interest or from loans, I mean, they're going to be shown on this income statement. So that is shown. Non-operating income or loss. This is just income that is just there. You know, it's not a core. That income did not come from the core operating processes of a company. Okay, non-operating income, you can have sell of assets. You know, a company decides to sell some of their factories or some of their equipment or machinery. That could be non-operating income. Non-operating loss. Let's just say a hurricane came by, and it kind of destroyed some of your machinery, and you had to repair those machinery, and you incurred a expense, and you put it in non-operating loss, right? So it's really, well, for non-operating income, it's very easy to kind of distinct them from your operating income. As your non-operating loss, they are somewhat kind of flirting with the operating expenses. They're basically usually what happens is that non-operating loss, they typically have non-recurring items in there, such as litigation fees. Litigation fees can be counted as non-operating loss. Machinery expenses, repairment of it due to extraordinary events can be non-operating loss as well. Okay, now your pre-tax income. Okay, so you get your pre-tax income after you subtract out your interest expense and you subtract out your non-operating income loss or whatever it is, and you get your pre-tax, which is EBT. Okay, so you see what we did here, right? We went from EBIT to EBT, and the I is gone. The reason this I is gone is that it's not before interest expense anymore. It's after interest expense. We have taken out interest expense. So what we have is EBT. Now, they're not going to call it, in the real world, they're not going to call it EBT. They're just going to call it pre-tax income or income before taxes. That's what your amount is. So you're basically taking your operating profit or your EBIT, and you're taking out the interest expense and taking out the non-operating income or loss. Okay? So, taxes. Okay, taxes, they're pretty self-explanatory. Basically, everybody has to pay their taxes. All their tax provisions that everybody has to pay, so there's no different for any company. So these are just their taxes that you're going to subtract out. Equity and income of affiliates. Okay, this is a little minority expense, and equity income affiliates are kind of opposite of each other. Okay, the equity income in affiliates is basically, okay, let's just say you are a CEO of a company, and you say, okay, we have to take 20% of our earnings and invest it into Walmart, right? Now, you invested 20%, you bought out 20% of Walmart's shares. That's a lot of money, right? That makes you a really important shareholder for Walmart, right? With that being said, Walmart is going to treat you as a income affiliate, okay, or equity income affiliate, which means that, okay, they recognize the contributions that you're making to their company. Therefore, they're going to give you a since your portion is very high your interest expense, your interest is very high, they're gonna give you a recognition on basically, if you have 20% ownership of another company, you're gonna put it on your interest on your income statement as equity, income, and affiliates. So let me repeat that again. Equity, income, and affiliates is basically when you have 20% or above ownership of another company, and you're being paid in interest or you're getting paid in dividends. That's where this income is gonna come from. Okay, right? So if you have 20% or higher, that's the rule. 20% or higher, and then you consider an equity affiliate, and you get paid those dividends, and you're gonna show those dividends on your income statement. Minority interest expense is actually opposite. Minority interest expense, if other companies have 20% or higher ownership of your company, and they're called minority interest because, minority is kind of like overstated. They're not actually minorities since they have 20% or higher ownership of your company. But this is just to go to show on your income statement that, hey, these investors are really big, and we just want to recognize the expense, that the interest expense or dividend expense, whatever we have that we're going to pay out to them. Okay, so these can, and you can see it says minority interest expense. You can have people like mezzanine loans maybe come up to minority interest expense, since mezzanine loans are also, although they issue out debt, some portion of their money that they give out can be considered stock based, so they're part shareholders and they're part debitors for that company. So you have people like that. That's not uncommon for a company to have. So you're gonna, under minority interest expense, it's kind of like an opposite of equity and affiliates. Okay, so keep that in mind. And as you can see, we're gonna make this negative since this is a expense, and this is gonna be plus because this is a income, right? So then after all of that, we're gonna have net income after taking our pre-tax and subtracting out our minority and adding our equity income, and then we're gonna have our net income. Easy. One thing you're gonna notice is that this information, your equity, income, and minority expense, is going to be found either on your income statement or is going to be found on the other portion of your 10K. Now, why do we do that? Well, like I said, it's a company's preference. Obviously, it's going to be easier if they put it on the income statement, but maybe that's not the case. Okay, so what they're going to do is that although it's counted into their income statement, what they do is that they spread out the equity and affiliates expense and minorities interest expense. They spread out the equity income and minority interest expense into non-operating SG&A or COGS. Okay, typically in your SG&A or your non-operating income and loss. Okay, so because think about it, what did we say about non-operating income? Income that's not attributed to the company's operations, right? This is not attributed to our company's operation. So is this loss, so it's more based on ownership and market ownership. So that's why you'll typically see them either spread it out in the non-operating section or in other expenses or SG&A. Now, in this case, that's what happened. They did not include it in their income statement, but on the other portion of the 10K, they have listed it. So what we're going to do, we're going to subtract these out, or we're gonna put these in, and later on, when we find the information, while we're normalizing our income statement, we're gonna bring this back to its right value. Okay. It's gonna be a little complicated, and I'm gonna try my best to explain as much as possible. But the normalizing part is probably the hardest part for the financial statement model, in my opinion. Okay. So on the net income, we got that. In our common dividends, we're gonna get that in from another portion of our 10K as well. And then we're going to take our EBIT, which is essentially a reference from cell D27. And then we're going to find our depreciation amortization from our cash flow statement, which is it's 2 pages after our income statement. And basically, depreciation amortization is a non-cash expense. Keep that in mind. It is a non-cash expense. And the reason I'm telling you to keep that in mind, so later on in the model, we're going to bring up that same fact. But the reason is a depreciation amortization. The reason we recognize it as expense is because let's just say that you are a company and you own a factory, right? And you're assuming from your appraisal analysis that the company's gonna have this factory, the life of this factory is for 10 years, and afterwards gonna sell it out to another company or whatnot, or sell it out to the market, right? Well, in those 10 years, you're saying that over time the value is going to decrease. Makes sense, right? Everything high costly related has some kind of depreciation, such as your car. Obviously, you know that when you first drive a new car off the lot, half of the value depreciates. That's depreciation. So keep that in mind when you are. That's basically what depreciation amortization is just the depreciation of your particular asset over time, right? Now, you're probably going to ask me, like, okay, you use the word depreciation a lot, but not amortization. Why is that? Well, depreciation is used for physical assets such as your property, your plant, your equipment, whereas your amortization is exactly like depreciation, except it only reflects with intangible assets, such as your patents can be amortized because they're there for like a set period of time. Your what other intangibles do you have? Your trademark, maybe. I don't know. Yeah, trademark if you have a contract with some company to kind of sell out your trademark or whatnot. And very like intangible assets. They're like ideas or intellectual property that you can depreciate. Sounds weird, but you can actually do that. As long as it has a time frame and it costs a lot of money, then it's gonna be depreciated or amortized. That's always the rule. Now what we're gonna do, we're gonna take this depreciation amortization and add it back, and we have the infamous Ebitda. Okay. Now what does Ebitda stand for? Ebitda stands for earnings before interest, tax, depreciation, and amortization. Make sure you know this before you walk into a finance type of an interview, because this is something what a finance major typically needs to know, is what an Ebitda is. And Ebitda is used for several different purposes, but is not actually stated on a 10K or 10Q. It's odd. It's really weird. But Ebitda is typically used for comparables whenever you're doing a comparable analysis for several companies, because you have multiples, common multiples like EV over Ebitda. Ebitda is kind of looked at, okay, if we're not considering depreciation, amortization, interest, tax, I just want to see how this company earns only on their operations, okay? How much profit that they get from their operations, okay? And what you have is this amount right here, okay? And Ebitda is commonly looked at just for that. Okay, so we're going to find Ebitda, and then we're going to go find other things such as our preferred dividends, and then our net income for basic EPS. And okay, so our preferred dividends are, okay, there's two types of shareholders. There's common shareholders and there's preferred shareholders. Common shareholders are people like you and me. We don't have that much capital. We just go on, Thinkorswim and buy a stock of a blue chip stock, something like Walmart, and we get paid dividends. Those are common dividends, right? Preferred dividends, on the other hand, are shareholders that have a lot more stake in a company. They have a lot higher stake. They have more perks, such as being paid first after the bondholders. Preferred stockholders are paid second. Then it's common shareholders. And they also get certain perks like converting their shares between preferred and common, cool things like that. And they also get preferred dividends. Okay, dividends are just for them, right? So we're gonna find that basically over here, and then our basic shares outstanding. Now, what does the word basic mean? Well, we're gonna be deriving off to another conversation if I talk about basic shares outstanding for too long. But basically, basic shares outstanding is, on a very fundamental level, is that just amount of shares are being traded at the market right now, the amount of capacity that the stocks are issued into the market. That's where your basic EPS is. Now, then we're going to get into diluted EPS, and the only difference between that is that we're going to take into consideration convertibles, stock options. Okay, if they were all exercised, and all those shares that were being issued after they were exercised what's going to be the diluted outstanding shares? Okay, so we're going to answer that question. But as of now, this is our basic shares outstanding. We typically get this from another portion of the 10K as well, which you're going to look at. And then your basic earnings per share. Basically, for every share of stock that you own, you're going to get $2.38 out of them. Okay, that's what the basic earnings per share says, projected obviously. So, estimating, you're going to get $2.38 off of your shares in 2004, basically, right? So EPS is looked at a lot. That's one of the most common. EPS and PE ratios are probably one of the commonest things looked at a company, like on the split second, or like for a glimpse of an eye. And the thing is, it kind of does not help you or justify anything. That's in my opinion, because it's not giving you a complete picture of a company. So earnings per shares, after finding all this information, you look at the EPS and you're like, okay, I understand why this EPS is so low. I understand why this EPS is very high. Or I understand why this PE ratio is so low or so high, etc., etc. And you kind of take into consideration other factors that maybe a typical investor does not consider when he's just looking at the PE or the EPS. So we're going to look at the EPS after considering all the other events that have taken place in the market. Okay? Awesome. Cool. So what we're going to do, I already did a 2004 over here, so you get an idea of where exactly am I getting these numbers from. 2005. Okay, sorry about that. Just got interrupted for a bit. So we're gonna go ahead and start with our 05 and probably 06, depending on how much time we have. All right. So 05. Let's look at. Okay, so I have my 10K open right here. So let's go all the way to the first page so we can kind of look at how exactly does 10K look at. Okay, this is a 10K right here, as we can see. Now we're going to just go to our income statement. So what I'm going to do is I'm going to press the right arrow, until I get to my income statement. This is all talking about the company, any legal procedures or litigations that have taken place. This is really interesting because they have put their non-recurring items in the beginning, which really helps me a lot. Or it's going to help you a lot too. You'll see, like, these are non-recurring items that we're going to consider. So we are. It's going to be on page. So we got cover this out. Yes, we have page 40, right? Now notice that even though it says page 40. Over here is page 38. Adobe does this weird thing where it doesn't count several pages. So keep that in mind whenever you're looking at the notes that I have put into the cell. I'm going by the PDF, not by that. But in this case, this is 40. Right, so this is our income statement. Your income statements can be very long, or it can be very small. In this case, it's pretty small, so it's going to help us out a lot. And right here, it goes from 2006, 2005, 2004. But if you look at our model, it goes from 2004, 2005, 2006. So with that in mind, make sure you don't flip the numbers. Trust me, it gets really easy to flip the numbers. So make sure your eyes are open and you're not copying the wrong numbers. So let's start from our net sales. Like I said, our revenue or our net sales. So they're the same thing. That's what you're gonna look at. So 11,396.9. So 11.96. Well, what was it? 396.9. 396.9. Now obviously it's gonna help you a lot if you have like two screens up. Trust me, it makes life so much easier. But if you don't, then I guess you just gotta deal with this. And also, you'll notice that over here, I forgot to format this part, but I guess that's good that we're doing it. Always, you'll see on the first row is gonna be in currency. So what you're gonna do, you're gonna press Control-1 to get to a shortcut for formatting your cells. Press Tab. You're gonna be right here now. As you can see, go to your currency and 1 decimal place. That's what we need. Our symbol. That's good. I like it. Now just press OK. There. For some reason, it did not do it for this. Wonder why. Oh, because I put 2 decimals. Huh, there. Okay, so now we're gonna go find our cost of goods sold. So you press Alt Tab, tab over to your income statement. Find your cost of sales. Cost of goods sold or cost of sales is 5191.9. Okay, so 5191.9. Then you go into your SG&A and other. Now make sure what I said. Now I said that SG&A has in some models where they lump together SG&A and other together. So that's what we're gonna do over here. So we're gonna go to our SG&A. What I do before I get into that, I go press this equal sign, just so I don't have to pull out my calculator, add these numbers together. You can just press the equal sign and just put in the numbers, right? So let's look at the first number. Selling and general administrative expenses. It's going to be 3920.8. 3920.8 plus. Then we have our other income. As you can see, is parentheses, which means that if it's in parentheses, it's going to be income. If it's not in parentheses, it's going to be an expense. In this case, is an expense 69.2. Okay, 69.2. Right? Get it? So we're gonna press enter. Now, before you yell at me saying like, "Oh, Adil, I thought you said that if you calculate your box or whatever it is, you have to have a white cell." No, if you have numbers in there, like over here, we have numbers, we have fixed numbers in here. It's gonna be yellow. Okay. If it's not fixed numbers, if it's something like just calculating the cells, no numbers, then it's gonna be white. So keep that in mind. So operating EBIT. So operating EBIT is basically your total revenue, subtract your cost of goods sold, subtract your SG&A. Great. So another way we can go about solving this is that, let's just say that you did the 2004 yourself. What you can do is you can just press Control C, which is Control Copy. Press Shift, or you can just do that, or you can press Shift in this. Your right arrow. You just press enter, and what you notice is that it copied over that calculation. So that's the one cool thing that Excel does, that it copies over the formulas. Okay, so we can do the same thing for E3 if we decide to put numbers into the E3 as well. For 06 as well. Okay, so let's do that for. Well, actually, no. I'll not do that. This is just something that you can kind of use to kind of speed through a lot of your modeling part. Okay, so interest expense. Now, interest expense. Oh, sorry, wrong key. Interest expense is going to be over here. Net income 136. That's our interest expense for that year. Non-operating income or loss. Now, this is the tricky part. Non-operating income or loss. Do we see it? No. Does that mean that it's not there? Yes. That means you don't have any non-operating income or loss for that year. So what we're going to do, we're going to put 0. Okay, so now we're going to calculate our pre-tax income, which is operating income or EBIT. Subtract out our interest expense, and then add our non-operating income, which is 0, and we can have 2079.0. Okay, cool. Now we're gonna go find our tax, and it's right here. This income before income taxes, that's basically another way of saying pre-tax, right? Now you'll notice that probably your number doesn't match up over here. Oh, it does match up. Okay, thought it won't. Yeah, it does. Awesome. That's cool. All right. For your provision for income taxes. 7027.6. Now remember, it didn't say at least it says income taxes or provisions for income taxes. Basically, that means taxes. All right. So 727.6. That's a lot of taxes. That's $727.6 million of taxes. Wow. Okay. Equity and income of affiliates and after tax. Okay. This is going to be very, very tricky. Number one, because it's after tax, and number two, it's not on the income statement, right? So this is what we're going to do. we're gonna like find it over here on a 107-page 10K. Well, there's a shortcut behind that. You just press Control F, your find box comes up, you can just put equity and see what we have. Go through it, find through it. Sometimes it gets really hard to find. Okay, maybe not equity, maybe it's minority. Let's try minority. There you go, minority interest. Okay, right here. Other expense, 55.3 for minority. So let's do our equity first, 2.0. So 2.0 right here. And then minority interest expense after tax, enter as negative. Okay, so what we're going to do, we're just going to put the minus sign for negative, and then we're going to minority interest 55.3. 55.3. Now you're probably going to ask yourself, why over here we put parentheses and now over here? Well, you'll notice that whatever we're going to do comparing to this 10K is going to be flipped. Whenever we have a negative number, there's going to be there will be no parentheses. And whenever we have a positive income, it's going to have parentheses over here. Let's say something like this, equity parentheses income. And the reason it does that is that it's just their preference, the way they want to do things, right? We want to use our minority expense as a negative over here, whereas over here our equity in parentheses is income. That's how they want to show it to us, right? And it's really preference of what the company does on their filings. Over here, minority interest is our actually expense. And one way we know that is because over here in parentheses, basically this tells us that in parentheses, whatever is in parentheses is our income, and whatever is not in parentheses is our expense. So yeah, that's what it does. Okay, so then we can calculate our net income, which is basically our pre-tax, okay, plus our subtract our minus our taxes, plus our equity and income affiliates, and plus 55.3, which is our minority interest expense. And even though we plus the minority expense, technically it's subtracting it out, right? Because this is a negative number. So that's what we're basically doing. So there you go. That's our net income. Now, how do we get our common dividends? Okay, we'll get our common dividends. Now, this is just from sake of memorization, but okay, let me just change the hand tool. Alright, this is just for sake of memorization, but we just have to flow back all the way to the top of the 10K, find our income statement again, and this is the way I do it. You can also search it in your bar, common dividends or dividends in general, and you should find it, but typically you know where to find it, which is fish through it. Okay, so this is our income statement, right? Typically when you have your income statement, that's when all your core statements are introduced, including your balance sheet, your retained earnings, and your cash flows. Okay, and what we're going to project as our balance sheet, our cash flow, and our income statement, not our retained earnings, because our retained earnings are more or less kind of like a statement that's there just to tie everything together type of thing. So we don't really need it. It doesn't have any useful information like other statements already have, right? It has something else to introduce. So in our income statement, our retained earnings, that's where we're going to find our dividends information, because the way our retained earnings is calculated, and you're going to learn this in accounting, is that you're going to take your net income, you're going to subtract out you're going to take your beginning balance of your retained earnings, then you're going to add in your net income, then you're going to subtract out your dividends, and then you're going to have an ending balance for your retained earnings. That's what it basically is doing throughout this whole time. Okay, so obviously as treasury stock too, just being generally how retained earnings are found. Okay, what are we looking for? We are looking for common dividends. Okay, common dividends. Now this is a weird part over here. Remember I said that common dividends and preferred dividends are two separate things? Well, in this case, we're going to add common dividends and preferred dividends together. Why? Because what we're trying to calculate is that, okay, sure, common dividends, common stock, common dividends are two separate things, but we still want to find out how much dividends is paid out. You know, maybe common is a wrong word. Maybe we should just say dividends, right? True. We can definitely say that. But common dividends actually has two separate meanings. Common dividends can mean preferred plus common dividends, which is your dividends from your shareholders, or it can mean just dividends from your shareholders, right? From your common dividend shareholders, right? So let me rephrase that again. Okay, common dividends can have two many meanings. One meaning that we can obviously pull out is that me, as a common shareholder, gets the dividend that's called a common dividend. Sure, that's one meaning. Another meaning is that me, as a common shareholder, get my common dividend. Also, the dividends for preferred stockholders as well. So we're adding those two together just to we'll probably need it in the future. We're going to subtract out this is going to basically help us find our basic EPS. That's what the whole purpose of putting both of those together. Okay, so alright, let's do this. Alright, so what we're going to do is we're going to go to Control Tab. Alright, so where's our our common dividend? So we're going to go to 2004. This is our 2004 segment, our beginning balance, our ending balance, not 2004, I'm sorry, 2005. Which is over here. This is our 2005 information. Okay, so it says to find dividends. Dividends declared. Series B, convertible preference stock, net of taxes, common stock, okay? Basically, Series B convertible, don't mix, don't let that screw you up, okay? That is dividends, okay? That's a long, complicated way of saying dividends. So these are our dividends, 28.2 and 57.9. So that's what we're gonna show on our statement. So we're gonna put 28.2 plus 57.9. 597.0. I'm sorry, 579, I think, right? Yeah, 579.0. We have 607.2. Okay, let me see if that's it. Shareholder issue of options, 28.2, 579. Cool. All right. So we're gonna get into, I would say, a little bit easier part. So our EBIT, earnings before interest and taxes. How do we find that? Let's see. Well, we found it right here. Operating profit. Our operating profit is our EBIT. So there you go. Depreciation and amortization. Okay, how do we find that? We didn't put it anywhere over here. How the heck do we find that? Well, the rule of thumb is that depreciation amortization information is going to be found on cash flows. Now, the reason it's going to be found on the cash flows, I'll make that more of a point when we move on in our model. But as for basic right now, focusing on the income statement, we're just going to go over where do we find it. So we find it over here. This is our cash flows. Depreciation amortization is going to be 329.3. So 329.3. Let me just double check. 329.3, yes. And then we're going to get our Ebitda. Now, how the heck do we get our Ebitda? Well, we went over this. Earnings before interest, tax, depreciation, and amortization. That's easy. We're just going to take that, our EBIT, and add back our depreciation and amortization. Okay. Now, before I kind of go any further, some of you are probably confused. Okay, why are we adding them back to get Ebitda? Why are we taking out the I in EBIT after taking out interest? You just get confused. You just don't know what's going on. Well, EBIT, keep in mind that in order to find before we even taking out the interest expense, before we even taking out the depreciation amortization, what you're going to do, you're going to add back those expenses. And that's what we did. That's the simplest way of thinking of it, that we're adding back our depreciation amortization to get our earnings before interest, tax, depreciation, and amortization. So keep that in mind, that just thinking of it like that will probably help you guys a lot. Okay? So our preferred dividends, how do we find that? Well, what we did was, okay, there's two ways to find it. Well, let me just go by the book way. Just go